Good morning, good afternoon, and good evening, everyone. We are from Group 3, and now we are going to explain about Psak 207, which is about Statement of Cash Flow. We are from Group 3, consists of Nadia Devitasari with NIM 2023-50096 and me, Tanya Maria Marcolin, with NIM 2023-50342. So, PSAK 207 regulates the preparation and presentation of the statement of cash flows, and its main purpose is to provide historical information regarding changes in an entity's cash and cash equivalents during a period. And this information is useful for assessing the entity's ability to generate cash and cash equivalents and assessing the cash needs for operating, investing, or financing activities. The statement of cash flows is very important for management, investors, and creditors to evaluate the company's liquidity and solvency. So PSAK 207 basically explains how to make and show the statement of cash flows, giving past information about changes in cash, and which this can help check how well a company makes cash and meets its needs for business, investing, and financing. So what is cash and cash equivalent? Cash includes physical cash, which is cash on hand that is available and demand deposits. And it consists of cash, savings and checking account balances, bank draft, money orders, petty cash, and currencies. Cash equivalent is certain assets that are highly liquid and easily convertible to cash, with a maturity period of less than 90 days. The examples include commercial papers, mutual funds and money market funds, short-term government bonds, treasury bills, and short-term deposits with maximum 90 days. So, understanding cash and cash equivalents is essential because it includes physical cash and easily accessible deposits, reflecting an entity's liquidity status. Next, we're going to talk about presentation of statement of cash flow. The classification of cash flow is there is operating activities, investing, and financing activities is vital for assessing a company's primary revenue generating activities. Operating activities originating from the company's main activities in generating revenue. For example, cash inflows from customer and cash outflows for purchasing raw materials, paying employee salaries, etc. Investing activities related to the purchases and sale of long-term assets or other investments. And for financing activities, it relates to how the company obtains funding. For example, borrowing money from a bank, issuing shares, repaying loans, paying stock dividends, and purchasing treasury stock. Presentation of the three cash flow activities can be adjusted to the characteristics of each company's business as long as it is done consistently. A single transaction may be classified into more than one type of activity. For example, making a loan installment payment to the bank of 10 million rupiah. This repayment may consist of two components. The first one is 7 million rupiah as loan principal, which can classify as a financing activity, and 3 million rupiah as interest payment, which can be classified as either an operating or financing activity, depending on the company's accounting policy. The first one we're going to talk about is cash flow from operating activities. Operating activities are the entity's primary revenue, which generates activities and other activities that are not classified as investing, or financing activities. An entity reports cash flows from operating activities using one of the method. The first one is direct method, which the major classes of gross cash receipts and gross cash payment are disclosed, and indirect method, where the profit is adjusted by correcting for non-cash transactions, deferrals or accruals of current asset and current liabilities, and other non-cash items. It is recommended to report using the direct method as it provides more useful information. So what are the cash inflow and cash outflow from the operating activities? For the inflow, it includes receipts from the sale of goods or services, royalties and other income, receipts from rental income and tax refunds, and receipts from grants to banks and the sale of securities by brokerage firms. For the cash outflow, it includes payments to suppliers of goods and services, payments to employees, payments for claims or insurance, purchase of securities and credit refunds, payment for operating expenses, and payment for interest and taxes. Here is how we calculate the operating cash flow from operating activities. If we use the indirect method, we use the one in the left side, which is we calculate by net income plus the non-cash expenses and then adjust it with the current assets or current liabilities. If the current asset increases, we minus the net income because we don't actually get money from the transaction. For example, is we buy an inventory. If we buy inventory, then our current asset will increase and our cash, for example, because we buy the inventory using cash, so the cash will decrease. So we decrease the cash if the current asset increases, and we plus the net income if the current assets decreases. As for current liabilities, we minus the net income if the current liabilities decreases because, for example, if we pay our liability to our vendors or other stuff, we will go will our cash will go out. So the journal will be accounts payable or other credits in the debit side and our cash will be on the credit side, so it will go out as well. So if the current liabilities decrease, our cash also decreases, and if our current liability increase, our cash will also increases. And we also have to adjust the gain and the losses because we don't actually get money from the gain and losses. As for the gain, we have to minus the operating cash flow, and as for the loss, we have to plus the operating cash flow. And for the cash flow from operating activities in direct method, we can calculate by cash receipts from customer plus the cash interest and dividends received minus the cash payments to suppliers and vendors minus cash payment for operating expenses minus payments for interest and income taxes minus other cash receipts and other cash payment. Next, we're going to talk about cash flow from investing activities. These are the acquisition and disposal of long-term assets and other investments that are not classified as cash equivalent. They reflect expenditures for resources intended to generate cash flows in the future. So the inflow includes receipts from the sale of fixed assets, intangible assets, and other long-term assets, receipts from future or forward contracts for financing purposes, receipts from the sale of debt or equity instruments other than those held for trading, and receipts from the repayment of advances and loans made to other parties. And the outflow includes cash payments to acquire fixed assets, intangible assets, and capitalized development costs, payments related to future forward or swap contracts for financing activities, and payments to purchase debt or equity instruments or investments other than for trading purposes. And then the last one, we're going to talk about cash flow from financing activities. Financing in the statement of cash flows shows activities related to a company's financing, namely how the company obtains and repays funds from external sources. The inflows includes issuance of shares, receipt of loans. The outflows includes prepayment of loans, repurchase of shares, cash payments by the lessee to reduce the balance of liabilities related to finance leases. And then for the interest expense, it can be presented as either operating or financing cash flow. Interest income also can be presented as either operating or in fact investing cash flow. For dividends paid can be presented as either financing or operating cash flow, and dividend income can be presented as either operating or investing cash flows. For the non-cash investing and financing transaction, we also must disclose the transaction that do not inflow do not involve cash flows but are related to investing or financing activities, such as the transfer of assets through finance leases or the exchange of shares. And then for the cash flows from interest and dividends must be disclosed separately and classified consistently. Companies must present cash receipts and payments related to interest and dividends separately from other activities and ensure that the method of presentation remains consistent over the time. The transaction related to income taxes and loan interest also must be clearly presented and separated from other cash flows to help users of the financial statements better understand the sources and uses of cash. And the statement of cash flow must include the effects of changes in foreign exchange rates so that any differences between the opening and closing cash balances can be explained, especially if the company has transaction in foreign currencies.
Okay, so the next one is this slide talks about an update of amendment to PSAK 207, especially section 44A until 44E, which is the rule says that companies must explain any changes in any debt that come from financing activities. The changes that must be explained including the first one, changes because of financial cash flow, like paying back loans or getting new loans, and the second one is changes when the company buy or loss any control of another business. And the third one is changes because of difference in foreign exchange rate, which is currency changes. And the fourth one is changes in any fair value or the market value of debt and any other changes. Next slide. And this is about the cash flow reporting on a net basis. Cash receipt and payment on behalf of customer if they reflect more the activities of the customer than the entity's activities, such as a payment of current account, customer fund managed by associate entity. And for the cash receipt and payment for item with quick turnover, large amount, and short maturities, such as customer credit transaction, purchase and sell of investment, and also short-term loans. For financial institution with net cash flows, such as the first one is cash receipt and payment related to deposit. For example, bank receive money from customer and later return the money when customer withdraw. And the second one is placement and withdrawal of deposit in other financial institution, such as when a bank places money into or pulls money out from another bank. They also report the net result only, like not every single move they will record. And the third one is advance and loans payment to customer. For example, when bank give loan to customer and customer repay the bank, they show the net movement. For example, like total loans given minus total repayment. The next slide. This is explain cash flow in foreign currency. The first one is cash flow from foreign currency. Transactions are recorded in the entity's functional currency by multiplying the foreign currency amount by the exchange rate at the date of the cash flow in transaction. And the second one is recording cash flow in functional currency. So cash flow of foreign subsidiaries are translated at the exchange rate on the date of the cash flow transaction. And the last one is consistent with PSAK 221. Unrealized gain or loss due to exchange rate changes are not cash flow. So exchange rate changes are reported in the statement of cash flow to reconcile beginning and ending cash and cash equivalent. Next slide. And the next slide is about investment in associates, subsidiaries, and other businesses. So investment are reported only related to cash flow between investor and investee. So cash flow from acquisition and loss of control of subsidiaries and other businesses are presented separately and classified as investing activities. So disclosure of acquisition and loss of control of subsidiaries and businesses, such as first one, amount of consideration and portion of consideration that is cash or cash equivalent. Third one is amount of cash and cash equivalent in the subsidiary where control is lost. And the last one is amount of asset and liabilities other than cash or cash equivalent where control is lost. Next slide. Other provision in Psak 207. The first one is operating cash flow, record as operating cash flows. And the second one is separation of cash flow. So cash flow must be separated from operating, investing, and financing activities. And the last one is the entity must disclose clear information regarding the amount of funds received and distribute and their purposes. Okay, the next one is the illustration of cash flow statement using direct method. This slide shows an example of a cash flow statement using the direct method of year 20x2, and it explains how the company received and spent cash in three areas, which is operating activities, investing activities, and also in financing activities. So the first one, we explain the operating activities first. So this is cash received from the customer. You usually get it by starting from the sales revenue in the income statement and then adjusting it with the accounts receivable. And then we get 30 million 150,000. And then we minus it with cash payment, which is from supplier and to supplier and employees comes from the cost of goods sold for buying inventory or materials and other operating expenses like salaries, rent, and utilities. And after we minus it, we can get the cash generated from operation, which is the nominal is 2,550,000. And also after that, we pay the interest, which is we get the uh, amount to 270,000. And and then we also pay the income tax payment, which is 900,000. And then after that, um we minus it all, and then we get the net cash flows from the operating activities, which is 1,380,000. And then we move to investing activities. The company spent cash to buy another business and fixed asset. It received some cash from selling equipment and getting interest and dividend. In total, we can see that it lost 480,000 cash from investing activities. And then we move to financing activities. It includes the company received cash from issuing shares and getting loans, and it used cash to pay lease and give dividend to shareholders. And from the transaction, from the cash flow, we can see that in total, the financing activities, it lost 790,000 in cash from financing activities. And overall, the company cash increased by 110,000, and cash at the beginning of the year was 120,000. So at the end of the year, it became 230,000. Next slide. So the next one is cash flow from operating activities. We use indirect method. They show how a company moved from profit to real cash money received and spent by adjusting several items, which is the first one is start with profit before tax. We can see with the company profit before tax is 3 million 350,000, and we need to make adjustment because profit is different from cash, so we need to adjust the adjustment for depreciation, which is we add back non-cash expense, which is depreciation, we plus 450,000, and foreign exchange loss, which is we plus 40,000. And then we subtract non-operating income because they're not from the main business. And then we need to minus the investment income, which is 500,000. And after that, we need to add back interest expense, which is cash needed to pay loan interest. There is interest expense. We plus it for 100,000. And after that, we adjust for changes in working capital, such as increase in receivable. The company give a credit to customer. The amount is 500,000. We minus it, and decrease in inventories. Company sold inventories, so that's why the amount is plus 1,050,000. And also decrease in trade payable, the company paid supplier. So that's why the amount is minus. So we minus it with 1,740,000. And and then for the result, after all the adjustment, cash generated from operation is 2,550,000. And we need to minus cash payment, which is interest payment. We minus to 270,000, and income tax payment, which is minus 900,000. And then we get the final result from net cash from operating activities, which is 1,380,000. Next slide. Cash flow from operating activities using indirect method for bank. This image show how to calculate cash flow from operating activities for a bank using an indirect method. So the first one is start with cash flow item. So we can see from the illustration, uh, these are interest and commission received. So money the bank earn is the amount is 28,447,000. And also there is interest payment, that money that bank paid to others, which is 23,436,000. And then recovery of previously written off receivables, so money collected that was thought to be lost, is about 237,000. And cash payment to employees and suppliers, so money paid to workers and vendors, which is minus 997,000. So we total it all and we get 4,224,000. And the next one is adjust for changes in asset and liabilities. These adjustments show how the bank asset and debt changes. So the first one, there is short-term fund decrease. So minus 650,000, which is means the cash out. And the second one is deposit for monetary control increase 234,000. It's plus because the cash in, and advance to customer it increased 288,000, and we plus it, and then the next one is credit card receive, and we minus it with 360,000 because it cash out. And then the next one is short-term trading securities. It also cash out, so this minus 120,000. And also the next one is bonds payable. It's no change, so there is zero. And deposit from customer, it increased 600,000. It means cash in, so we plus it, and the trading certificates of deposit, it decreased to 200,000. It means cash out, so we minus this account. So that's why, so the total for this adjustment is 3,440,000. It before taxes. And the next one, we need to pay the income tax payment, which is 100,000. Because we pay the tax payment, so the amount is minus. And after we pay the taxes, the final number is 3,340,000. So the net cash from operating activities is 3,340,000. So this all from us. Thank you for the time and thank you for listening. Thank you guys.